The trading strategy I'm about to show you can change the course of your life. In fact, you can use it to go from zero to over $9,000 a week, and that's exactly what it's allowed me to do. If we go ahead and look at the proof, I'm logged into my Charles Schwab account right here, and for the month of November, I was able to generate $36,147, which is a little over $9,100 per week, and I'm gonna show you exactly how you can do it. Now, before we get started, make sure to hit that subscribe button if you haven't already, and make sure to smash that thumbs up button if you get any value out of this video. And if you have any questions along the way, you can comment them down below, or you can message me directly on Instagram at It's Ryan Hildreth. I answer all messages on that platform, and I love to connect with you personally. So let's go ahead and jump into the exact strategy. What we're gonna do is we're gonna go over to tradingview.com. It's a free website. You can utilize this software, and we're gonna pull up NVIDIA. This is the stock that made me so much money in November. In fact, it contributed to like 90% of the gains that I made in that month. So we're gonna go to NVIDIA, we're gonna go to indicators, and we're gonna type in a very special indicator that literally is the bread and butter for this strategy. So we're gonna type in Bollinger Bands, okay? We're gonna type in Bollinger Bands, and as you can see, that's right here. We're gonna click on that, okay? And that's gonna add these bands to the chart, but we need to make sure there's one thing straight. So we're gonna go right here, go click on those three little dots, and we have to go to the settings to make sure there's a specific setting that is set. Make sure that this right here, STD deviation, standard deviation, is set to 2. And what that means is that these lines right here, okay, this upper Bollinger Band line and lower Bollinger Band line are set at 2 standard deviations away from the average price of the stock. Now that means that 95% of the time, the stock is gonna stay within these 2 lines, okay? So let's go ahead and press play. I wanna show you specific scenarios that we can play out, that have played out really well on this stock, okay? And you could use this for any stock that you trade, but let's go ahead and play out the replay. So as you can see, the stock went down right there and went outside of this lower Bollinger Band. Now that happens only 5% of the time. And when that happens, usually the stock will snap back up right into the Bollinger Band channel, okay? And as you can see, it did that right here. So that was a key opportunity, right? And we can go ahead and mark that. That was a key opportunity to trade this particular stock. Now, I'm gonna show you exactly how I trade it, because it's not just buying the shares and waiting for it to go up. As you can see, it did, but I'm gonna show you exactly how to make sure you're winning 98% of the time, like I do, right? 98.33% win rate in November trading options, okay? So we're gonna go back there. As you can see, stock went down, snapped back up into the Bollinger Band, and we'll just let this play out. And there's many other opportunities. Boom, snap back way outside of the Bollinger Bands, okay? This was a huge situation on August 5th. The whole market was tanking. But as you can see, this was an outlier move. And what happens is mean reversion. So usually stocks revert back to their mean price or average price. So we're gonna press play. I'm actually gonna mark that because that was a prime opportunity that made me a lot of money, okay? And as you could see, boom, snap back up, and this thing went all the way back up. Almost, yeah, we're going to the top Bollinger Band, okay? In that instance right there, I'm gonna pause. This was a good indicator as well. So this works on both sides, right? To get long the stock, you wait until the stock breaks below that bottom Bollinger Band. And to get short the stock, you have to wait until the stock breaks the upper Bollinger Band. And let's see how this plays out, okay? So it touched it right there. And as you can see, trading sideways, and boom, back down to the average price. And it snapped all the way back down to that bottom Bollinger Band. That was a key moment right there, okay? Touch the bottom Bollinger Band. You don't always have to wait until the stock is outside of the Bollinger Band. You can wait till it touches, and it did right there. It touched that bottom one, and that's usually where I take an entry, okay? And you can see what happens. Boom, goes back to the mean price, and then I believe we shoot back up, okay? Traded kind of sideways there for a few days, and we shot back up, okay? So you would have made a lot of money on this trade. You would have made a lot of money on this trade, a lot of money on that trade. And these trades only last for anywhere from a couple days to a few weeks, okay? Now this one was literally 2 days. This one lasted a good, couple weeks. This one lasted several weeks, okay? And you could have taken another position right here as well, which this would have been a short position, okay? And we'll cover those as well. But as you can see, this is how the Bollinger Bands play out. Usually 95% of the time, the stock stays within those bands. Now, what I'm gonna show you is how to trade options on those, because there's a bunch of options that are out here that people are buying, okay, outside of these Bollinger Bands that expire worthless. So I'm gonna show you exactly how to sell options to those people who are buying lottery tickets, that those options literally 95 or more % of the time expire worthless. In fact, my trading strategy, 98% of the time they expire worthless. So I'm gonna show you how to sell options with the odds in your favor. When I discovered this strategy, it changed the direction of my life. In fact, I've been able to essentially retire, and live off the income that I generate from selling options. So this is the only strategy you should be trading if you want consistent income every month, every week, and every year, all right? Now, I do not day trade. I only swing trade because most of these trades will take more than 2 to 15 days, right? They take anywhere from 2 days as long as 30 days, but either way, you're gonna generate income every single month. Now, 95% of these options expire worthless, meaning the person who bought that option, the right to that option from you, does not get their premium back. So they paid you and they don't get that money back. You get to keep it because basically you sold them that option that expired worthless, just like insurance companies, right? You pay your car insurance. Do you ever get that premium back? No. And it's rare that you're gonna get an offender bender and actually use that insurance premium, right? So it's very, that's how insurance companies are so profitable, because you pay them every month and you don't even use the insurance 99% of the time, right? Now, there are some cons, some risks that you do have to take. And I'm not gonna say that, this is a 100% you're gonna win strategy, because if it was like that, then everyone would be doing it. There are specific risks that I'm going to outline and show you how to get around those so you don't have to worry about them, okay? Now, if the option expires in the money, you'll be forced to buy or sell 100 shares of the stock. So if you don't have enough money to buy 100 shares of the stock, don't worry. I'm gonna show you how to do it with a small account as well. But I'm just, for my sake, I always do it, I have a large account, so I could buy 100 shares. That depends on if you sold a call or a put, whether you're gonna have to buy 100 shares or sell 100 shares. Okay, that's for big accounts only. Now, the other con is if the stock goes below the price of your option spread, so if you have a small account, I'm talking to you, you lose a defined amount. So you can never lose more than the defined amount, which is great. You could set the trade and say, hey, I'm willing to risk, $500 to make XYZ amount, right? So it's pretty cool that you can see your probabilities, you can see the probabilities of the trade, get in at an optimal time, and then profit, right? And I'm gonna show you how to do that, okay? The pros definitely outweigh the cons. That's why I've been able to do this profitably through the 22 bear market, right? 2022 bear market that lasted all the way up until really 2024. That's when we fully recovered. I was able to be profitable through that, and I'm even more profitable nowadays. Obviously, we're in a bull market, okay? The pros are high probabilities in your favor, and you can adjust the probabilities to the amount of risk you want to make, right? The amount of risk you want to take, or the amount of money you want to make. If you want to make more money, you got to take a little bit more risk. So the probabilities go down just a little bit, but they're still going to be like over 80%, okay? So let's go back to the chart, and I'm going to tell you, look, every time that we break that bottom Bollinger Band or we touch it, I'm selling an option down here, okay? So the stock went from, let's just say, it opened up at around 111, okay? Then the stock tanked all the way down to 103, okay? That's over 8%, right? That's over 8% down. And what I did was I sold a put option to someone who purchased it from me. And I sold the put option down here at like 95, right? So the chances of the stock going even further than 2 standard deviations is extremely rare. And most of the time it doesn't happen. So I felt comfortable selling the $95 put all the way down here. I knew the stock wasn't going to go down there. And of course, it snapped back up all the way from 103 to 2 days later, 120. Okay. Yeah, it went to 120. So it literally went up like 16, 17% in 3 days, right? And that 95 put that I sold for, let's just say $500 was worthless, completely worthless, because the probabilities of the stock going back down to 95 from 120 are basically zero. So the option was worthless. I closed out the trade, collected my $500, and the person who bought it from me, well, shit out of luck, right? So I do that every time. Then this time was a great time. I sold you're able to sell like the $75 put all the way down here, which there's no way NVIDIA was going to go down there, because the last time it was down there was like back in April, right? Like 4 or 5 months ago from that point. So there was no way that I was going to do that. And of course, I was selling these puts down here and the stock snapped back up to the average price, okay? Those options that I sold down here, the put options, there's no way the stock was going to go down there. The person who bought those options from me believed the stock was going to go down there, and they thought they were going to make some lottery money. And, they didn't. They had to pay me, and I closed out the trade, okay? So I do that every single time. I also sell calls against my shares above the Bollinger Band. So like when it, went all the way up to 130, I was selling like the 140s. And of course, the stock tanked. There was no way these calls were going to be worth anything, especially since the stock tanked. I got to keep the whole premium, okay? So that's how I do it. Now let's go ahead and go into the dynamics of how to do it. So first, we're going to talk about big accounts. So if you have more than $10,000, this is going to apply to you. If you don't have more than $10,000, then you can fast forward ahead to where we talk about vertical spreads, okay, credit spreads. So we're going to talk about cash secured puts and covered calls. This is my favorite strategy. The reason I love this is because the worst case scenario, okay, which happens 2% of the time, this very rare, and I have gotten assigned, is that you get assigned on the stock, okay? You buy the stock at a deep discount. Like if we go back to NVIDIA, let's just say we sold right here, we sold a put option at 100, okay? And then we didn't close out the trade because, after a couple days, we're like, we want to collect more of that premium. And then boom, the stock tanked all the way down to 92. We'd be forced to buy 100 shares at $100 and just hold it until it goes back up. And in the meantime, you could even sell covered calls against it to collect income, okay? So that's the worst case scenario for the cash secured puts. Covered calls, the worst case scenario is you have to sell your shares at a profit, plus you get to collect that covered call income, which it's a double profit. So there really is no cons with a covered call. Like literally no cons with the covered call, unless you sell a covered call below your cost basis, which you would never do. That's something you would just never do unless you like losing money, okay? So what we're gonna do is we're gonna sell a 30 to 40 delta put 30 days out. This is exactly how I do it. And that should yield between 3 and 5%, okay? So you should be making 3 to 5% on your money per month. That equates to over 30% to over 50% per year. And I've been able to do that for the past 4 years, over 45% year over year consistently. And that's because I'm doing this strategy, which is high probability, great reward. And the calls, you're going to go a little further out. And on the call side, you actually yield more because you're going to sell a far out of the money covered call against your shares. And then eventually the stock is going to go past your calls and you're going to be forced to sell your shares at a profit plus the call income, which should yield you anywhere from 3 to 10%. Okay, so let's go into a live example. I'm here in my one of my bigger accounts. Okay, this account has 688,000 right now. And as you can see, I have a lot of cash secured puts and covered calls on NVIDIA. This is my favorite stock to trade. So we're gonna go to NVIDIA. What I would do is I would go to the option chain. I would go, I know it says 29 days out, so let's just go to the 36 days out, all right? And we're gonna go to that somewhere in between 30 and 40 delta, okay? Now 30 delta has a 30% chance of being in the money. So your probability of not being in the money and just collecting that whole premium and not having to purchase the shares is about 70%. And that's why I particularly like this delta, because I like to take a little bit more risk. I don't mind owning the shares down here at 130 and I'll get paid more, right? If you want a higher probability trade, yes, you could go down to like, the 16 delta, but you're only gonna collect $1.49. So let's see the differences in premium. All right, so let's say we sold the 132 strike, which is a 34 delta. This has a 66% chance of expiring out of the money, meaning we get to keep the whole premium and we don't have to buy the shares. So it's 415 bucks we'd collect, right? 415 divided by the strike price, because that's how much capital we will have to have as collateral, 13,200. So let's just do 132. And that's about a 3.14% return. Okay, so 3% on your money, great. Now, if we wanted to be safer and go down here to like the 15 delta, right, and have an 85% chance of not having to buy this stock, but in just keeping the premium, right? So let's do that. You'd collect $1.39 divided by 121. All right, so that's only 1.14%. All right, so yes, okay, that's a great return. Like if you were to just annualize that, you'd make, I don't know, 13%, which is 13 to 15%, somewhere in that, compounding every month. That's great, you're beating the market, but you're trading a volatile stock, so you might as well get paid to take the risk. So that's why I prefer the 30 to 40 delta, okay? Now, let's go to the covered calls. So what you'd have to do on the covered call side is buy 100 shares, okay? If you want to collect income, you'd buy 100 shares, and I would wait until an opportune time. So like maybe if the stock has a little bit of a pullback to that middle Bollinger Band, right? Like right now, I believe the stock is definitely not there. We're kind of like at 136. Actually, we might be near there. So let's just say it did that. I would buy the stock, okay? And then let's just say I want to collect income now. What I would do is I would buy 100 shares and then sell the covered calls, okay? So on the covered call side, you want to go a little bit further out. So I would go to like the 25 delta. Let's just go to the 152 strike, all right? So let's calculate that. So you'd collect $2.30, or yeah, $2.30, but times 100, so 230 bucks divided by, let's just say you bought today at 137, okay? So that's about 1.67% return on the covered call income, which is great, but we want the stock to like blast through our call, so we have to sell the shares at 152. So let's just imagine we had to sell the shares at 152 minus 137, okay, divided by 137. That's about a 10% return, 10.9% return, plus an additional 1%. So we're at like almost 12% return on the covered call side. So I always make more money on the covered calls. Now, let's talk about small account strategies. How do we trade this with less than $10,000, okay? What we wanna do is we wanna use a platform like Tasty Trade, which we'll go to, and how this is gonna work is first we're gonna talk about bull put spreads. This is a bullish trade. So if we go back to the chart, I would enter a bull put spread at all of these times where the stock touched the lower Bollinger Band, okay? You could even enter when it touches the middle Bollinger Band, but with a small account, you want to be safer. So I definitely would wait until these opportune moments, which happen maybe once or twice a month. Okay. So what we're going to do is the defined risk trade. We're going to sell a put here. We're going to buy a put to make it a spread. Basically, what happens is we're selling a put for money, right? We get to keep the premium. But because we have a small account, there's unlimited risk on the downside. If the stock goes past our put, we can lose as much money until the stock hits zero, right? And that's not good. We could lose our whole account, and we don't want that to happen. So what we do is we buy a put to cap our risk, all right? So let's just say the stock's trading at 110 right here, okay? We'd sell the 100 put and we'd buy the 95 put. So we're risking 5 points, so $500, right? Because if the stock goes below this put, we're losing money on it, right? On the one we sold. But if it goes below this put that we purchased, right? The profit from this put is covering the loss of this put. That's why it's called a spread, okay? So you really don't want the stock to go below this strike. But if it does, you start losing money. And then if it goes past this one, you have a max loss of $500. You can't lose any more than that, even if the stock goes to zero, okay? So that's how it works. As long as the stock stays above 100, it's currently at 110, then you get to keep the money, all right? So let's go ahead and enter the trade, all right? And don't worry, like, how you should be doing this at first is probably practicing in a paper trading account. And then you could trade like SPY, which is the S&P 500, just to be safe, right? I wouldn't start on NVIDIA as your first stock to trade credit spreads, all right? But let's go ahead and jump into it, all right? So we're gonna go to NVIDIA, and this is how I'd structure the trade. I would go 36 days out, and I would go here. What's really cool about Tasty Trade is they have this feature. You'd go to vertical, that's what it's called, a vertical spread, which is we're gonna do a short put vertical, okay? All right, which means we're selling this put, we're buying this put. So, and then what we could do is move the strikes, okay? We're gonna go to that 20 to 25 delta. To be safe, I would go 20 delta and then extend the width 5 points wide. So we're gonna go here to the 21 delta and move this down to 120. So on this particular trade, okay, we are risking $88, or we're risking $412 to make 88. So we're risking more to make less, but the probabilities are in our favor. So the probabilities of making 50% of profit, meaning $44, is 85%, right? And probability of 100% of the profit, the $88, is 75%. So you can adjust this to kind of meet your, meet your requirements. Like if you wanted to go to the 15 delta, increase your probability of profit, but maybe widen out the spread to risk more, to make more, okay? Which I wouldn't do. This doesn't look very good. Risking 912 to make 88, that doesn't make sense. So I would just go 5 points wide, okay? I would go to the 125, 120. That's the perfect spread. You're risking 412 to make 88, okay? And what I personally would do with a small account, this is what I did back in the day, was I would close out at 25 to 50% of profit and just keep putting on new trades, okay, on different stocks, different underlyings. And as you can see, your 89% probability of 50% of profit, you might hit that in a few days and then just close out the trade and wait for another opportunity or trade a different stock that has an opportunity, okay? So that's what I do on the bull put spreads. Now, bear call spreads, these are bearish. So this is how you get short the stock or short the overall stock market, okay? Like for instance, if NVIDIA was touching these top Bollinger Bands, I would have sold a bear call spread here. I would have sold one right here. I would have sold one Not right here because we had such a big kind of like up move. I didn't think it was going to go down. I would do a safer one, maybe sell one out here. All right. And then, yeah, maybe one more right here. Okay. So let's go over the bear call spread. We're going to do defined risk, 5 points wide, so we can only lose $500. And basically the stock just has to stay below, right? Let's just look at the diagram. Stock's trading at $300. We're going to sell the 310 and we're going to sell the 310 and buy the 320, okay? Or buy the 315. Right? So as long as the stock stays below that, we are good. We're going to make our money. Always wait until stock is up and is closer to the top Bollinger Band to enter this trade, 20 delta or lower. All right. So let's go ahead and go to Tasty Trade and do the trade. So we're going to go here and change this to short call vertical. Perfect. All right. So we're going to go out to the 20 delta to be safe. We're going to move that there. And then that's the 154. So we're going to have to move this to the 161, which they don't have. All right. So we'll move this to the 155 and 160. Perfect. So we're risking 434 to make 66. Now, if you want to get a little bit riskier, you can move this to the 25 delta, which is 151, and move this here to the 156, right? You risk 413 to make 87, and your probability of 50% of profit is 84%. I like this trade a little bit better because you can make a little bit more, okay? So that's exactly how you do the bear call spreads. Now, this changed my life. Hopefully, it can change yours. If you want to learn more, I have another full tutorial right here. Make sure to watch that video, hit the thumbs up, and I'll see you in the next one. Take care.